Welcome back to the What's More podcast. I'm your host, Quinton Harris. You're dialed in for episode 241. In this episode, big week, we're going to talk about tariffs, reciprocal tariffs, what that means, and the act of an economic war. All that and more in this episode at What's Your One More. All right, so it was supposed to be a big week here on the show in the form of job week. You know, we always break that down. It's a very big week. You can kind of compare it to the Federal Reserve, but that was completely overshadowed by the tariffs issued this week by the Trump administration and then reciprocal tariffs from some other countries that those tariffs were imposed upon. And in this week, I want to focus this episode on the impact of those and then what happens from a reciprocal impact and then also what it does to mortgage rates. Like this is obviously the show is designed around real estate, and there's a lot of things that if you go back to some previous episodes, and I'm going to talk about those and we'll play some clips where we forecasted a lot of the things that are happening right now would happen. And some of those were driven by potential tariffs of the Trump administration, but a lot of it are other things that are happening that are starting to fall into place. But this tariff might be the escalator, that we didn't see coming in the form in which they're happening. They are right now. And you'll see what I mean here in a minute. So these were definitely shots heard around the world. What I mean by that is that the tariffs that were issued this week by the Trump administration and referred to as Liberation Day, there were just no doubts about them. I mean, there were shots fired in the form of some serious tariffs levied around countries all around the world. And when I say that is that the U.S. has been operating at severe trade deficits for quite some time. I'm not saying that's the previous administration's fault or the administration before that or before that or before that. It's just a fact that we've been operating at serious trade deficits. And that is also being looked at as unfavorable terms to the United States. When we are deemed as the world's greatest economy, we're getting some not so great deals. If you think about this, like if you have the upper hand in a negotiation situation, you should probably be getting the better deal. And in many cases, we were not even trying to do that. So what the administration is trying to accomplish right now is even the playing field. And so President Trump announced his reciprocal tariffs on the countries of goods in which we export things from. And the way that he calculated those tariffs, I thought, or his team calculated the tariffs, was pretty interesting. It wasn't by just taking the actual tariff percentage, if you may, that we essentially import from them. What he said was he said, hey, I'm going to take our trade deficit by each country, and then I'm going to divide that by how much we import from that country. And then I'm going to take that number and I'm going to cut it in half. So let me give you an example. So I've got a chart here. It'll be in our YouTube channel at What's Your One More with the number one. So if you get a chance, go to our YouTube channel at What's Your One More with the number one. You're going to see a couple of charts in there. Kudos, hats off to our friends at MBS Highway, Barry and Dan, always doing a killer job over there, and love sharing their stuff. And by the way, if you're not a part of MBS Highway, go join that. You get every bang for your buck on that. But with combination of those guys and John Malden, you're going to see some things here that are pretty quick breakdowns of the tariffs that I haven't seen anywhere else, which is why I'm bringing it to the show here. But this quick calculation, I'm going to use China as an example in here in this chart. So in the example, you're going to see that our trade deficit with China, this means this is what the difference between what we import and what they export. So this is the difference between what they import from us is $292 billion. And then what we import from them is $434 billion. That's a lot of import. And the differential of those two things when you divide them is 67%. And what the administration did was they said, hey, we're going to take half of that 67, round up to 34%, and that is what we're going to impose on this country to balance the trade. And this is not a punishment to China as much as it is to offset some things here in America. And so that's how they came up with each one of these. And in a minute, I'm going to break down a lot of the countries and kind of show some things that are impacting and why we would do that. And you could almost ask, is this a negotiation tool or is this an escalation tool? And I think that, even coming right into this podcast, we saw a segment where Trump said, this is absolutely a negotiation tool, but I don't want it to be lost on the fact that, Scott Bessent, along with many other people as part of this administration, have said, these are not temporary. Like, we are doing this for a purpose, and they're going to be here for a duration. It's also a one-time event. This isn't something that carries on in the form of like a new tariff's coming next week, a new tariff's coming again. Like, it's a one-time tariff that stays and it carries out until the duration's over or the negotiations are met. And we're going to talk about what some of those negotiations could mean for the U.S. But it's hard to calculate like the effectiveness of these tariffs because there's so many things involved with the countries. You got currency differential, you got regulations, and the fact that some of these products that are tariffed are much more than others. Cars versus goods. There's just a lot of things to calculate. It's hard. I should say it's hard to calculate what the impacts of these are going to be this early on. But it does give the appearance that there's going to be a standoff here and like who's going to blink first. Because, within 48 hours of the United States issuing these, you had a couple of things change, right? So we'll talk about those in just a minute here, but keep in mind that these are revenue generating tariffs. I think this gets lost in the media right now because as I'm watching and I'm reading, there's a lot of concept that this is to punish, but these are revenue generating. So if you're a listener to this show, what I'm about to say doesn't come to any surprise to you. But if you're a new listener, obviously welcome to the show, but also wanted to say we did many episodes on the national deficit. And the challenge with the national deficit is that it continued to go up in exponential rates. And the other challenge is that it's gotten so big, it's getting to the point where it's almost deemed to be irrecoverable, meaning that you're never going to pay it down. And let's talk just a minute about the national deficit, for example. Let me give you some high-level points of what compiles the national budget each year, right? And then if you don't make enough income, the budget becomes a deficit, which has happened so many years in a row, which is why we are where we are. But the number one, and this is kind of in order, the number one cost in the budget each year is Social Security, right? That doesn't come as any surprise. And by no means does anybody want to cut Social Security, regardless of what the media says. You don't want to do that. The second thing is the interest payment we actually make on the national deficit, So the payment we make each year on that money that we owe, that's now become the second largest budget on the year, part of the budget on the year. Like, that's crazy. The third thing are VA benefits, and obviously we want to keep those. The fourth is national defense. Like, those are four things you cannot get rid of, right? Those have to be. And the things that follow after that are so, I don't want to say remedial in cost structure, but it's hard to say, well, if we wipe those off, we could get rid of the debt, because you have to have some of that stuff as well. So then you look at, okay, how do you fix the national deficit? And this has been a topic we've had on this show for quite some time. And one of the things was maybe you raise income taxes across all levels. And that is a very, very sensitive topic, right? Because that's what the American people don't ever want to hear. Like, if there was a candidate that ran on, hey, I'm going to fix the national deficit by raising taxes, you don't stand a chance. You might as well not even run, because no one wants to hear that. And then the idea of, like, we've heard of VAT taxes, and you see those in other countries. But the reality is the American people don't want their income taxes to go up, thus affecting their revenue. Now, flip the script a little bit. What if we could make the other countries pay more, and therefore, I don't know, using that money to reduce the national deficit? And that's essentially what the plan of attack is with this. And that's also why this is an income-generating tariff, and it's it's not a temporary tariff. You don't see this going away. This is there to help offset and reduce the national deficit. It's a plan the administration has in place. It's hard for the media to understand this, because it's easy for the opposing side to talk about the destruction of the economy, the stock market going down. Yeah, those are real things. Like, I'm not naive to that. We've had 2 days. I think if I'm looking at it right now, it's close to 9% losses in some of the indexes. That's real. That will also come back. I think what is being lost in this is that these tariffs are going to force some of these corporations that are outsourcing American jobs to other countries to bring those jobs back into the United States, to bring facilities and factories back into the United States and distribute their product here in the United States. And that will bolster everything that you're potentially focusing on that went down right now to go right back up and then some. And it's going to build a better economy and a stronger economy that's more dependent on being here than being in another country. And I think that's a very lost point in the media right now that I think needs to kind of be published more, quite frankly, because yes, I think I saw a statement on Truth or on X and other social medias where Trump said, and I thought this was great, the patient's surgery went well and is now in recovery after issuing the tariffs. And I thought that was kind of humorous, but at the same time, it's a great example of the economy going under surgery and now is in recovery. And I think that's what we're going to see happen here. But the little thing about this that's interesting is that I'm going to go through these tariffs of what is happening to other countries. And in this graph, again, it'll be in our YouTube channel at What's Your One More with the number one. This is a really interesting graph because I have not seen this anywhere at any point. And I was kind of really stoked when I saw it because it breaks everything down pretty eloquently. Again, this will be in our YouTube channel. If you're listening to this on Apple or if you're listening to this on Spotify, flip over to YouTube because I was sharing this with someone today before I came on the show, and he's, really dialed in to the economy. And he's like, holy cow, like this was a really cool graph that explained a lot of things. So what this graph does is it breaks down particular countries, not all the countries, but it breaks down about 7 of the countries that are impacted by these tariffs: the EU, European Union, China, Japan, Vietnam, India, Thailand, and Cambodia. And what it does is it takes the tariff in the column, shows the tariff that we're imposing on them in the United States. Then it shows the GDP of that country in billions. And then it shows the export to the United States, like currently what they're exporting to the United States. And then it shows you what the tariff and what the export of goods are in reflection to the percentage of GDP of that country. So their GDP, you divide the exports into their GDP, and it gives you the percentage of GDP. So basically, how much money that country is making off of those exports, the percentage of that. And then the far right side is the trade barriers. And this is kind of where the conflict is happening right now. Like, what is the barrier of trade, and what do we either want to negotiate or what's going to get escalated? And I think that's interesting. So one thing in this graph that's not in there, and I'll mention, is that the U.S. is roughly $29 trillion in GDP. It's not on here, but it's also why we're referred to as the greatest economy in the world, because statistically speaking, we are also the greatest economy in the world. And I just wanted to point that out because it dwarfs the rest of these when you take a look at it. But in less than 24 hours from those tariffs that we imposed, you had a couple of different examples of negotiation and escalation. Now, I'll start with the negotiation. In less than 24 hours, Vietnam came right to the table. Because if you look at Vietnam, the tariff we levied on them was 46%. That's pretty high. If you look at their GDP, their entire country's GDP, that's $443 billion. Keep in mind, ours is $29 trillion, but $443 billion to the country of Vietnam, of which they export to the U.S. $142 billion. Now, that represents 32% of their GDP. You could argue that's a very significant amount, right? I would say it's way significant. Some of these others at 3 and 4 are significant. This is astronomical, right? But look at what the trade barrier is there. It's essentially they put a 30% tariff on cars. Well, we don't think that should be there, right? That's not a good deal. So you look at it, they've come right to the table and they said, hey, we're willing to negotiate and remove our tariffs down to 0 if you're willing to work with us. Now, that's a negotiation, right? That's a good tool, and that shows up. And there's going to be some other countries that do that as well. But, us having to get to this level to eliminate that tariff, that's a big deal. And that's economic money right back into the United States, which can lower the national deficit. And that could be a win. That will be a win. And that's why they're doing this. Now, a form of escalation that happened from this graph, if you may, and I think this comes as no surprise, is China. Right. So if you look at China, we put a 34% tariff on them. Now, that's just a portion of the current tariff that we had on there to them. This is not all of it. It was just a new added one that we had to it. I believe it was already at 20%. So it's probably, over 54% at this point. But their GDP represents $18 trillion. Again, United States 29. I'm going to keep hammering that home. But they export to the United States $450 billion each year, which represents 3% of their GDP. Now, you might say 3% is not a lot, but 3% is big. Like, if you get a 3% GDP growth, we're very excited. If you get a negative 3% GDP growth, it's like, whoa, what happened? So those are big numbers on that, difference between 18 trillion and 443 billion. Like, you could do the math. 3%'s a lot. And so they came to the table, and instead of negotiating, they said, hey, we're going to hit the U.S. with 34%. The same tariff we put on them, they're going to put right back on us. And I think that's another reason why you're seeing the stock market, I don't want to say freak out, but you're seeing declines because so many companies depend on lowering their cost structures, whether it's on goods, whether it's on employment, you name it. It comes from these other countries, China being one of them. So I think there's clearly this recessionary fear, the R word. We're not supposed to say that on the show, the R word, but recessionary fears that are out there because of this tick for tack and these negotiations and, quite frankly, escalations that could be creeping out there. And so this leads to the next point. If you remember at the beginning of the year, I did an episode, and I'm going to play a clip here, but I did an episode, and I'm going to cue it up and let my producer go ahead and play it for 1 second. I think it's a head fake. I think you're going to have more than 2 rate cuts in 2025. And I'll continue to stand by that because if you look at the dot map, right, that was the big freak out in the market was the dot map. But if you think about the dot map, it's inaccurate 60% of the time, meaning from the quarter in which they previously released it to the next quarter you look at it, oftentimes it doesn't hold true to the projection that was originally on there. It's a moving projection. Okay, so you heard that clip. So even back in January, the Federal Reserve, I guess coming out of the December meeting, said, hey, dot plot map. Do you guys remember this? Hey, we're going to do 2 cuts and nothing more on the year. We believe the economy's strong. It's intact, all the stuff. And that entire episode, I debunk everything they said. And I called it a head fake. I said, there's no way that the Federal Reserve is going to maintain the entire year at 2 cuts. And I gave multiple reasons why in that episode. Head fake is what I called it. Well, here we are now. And the Fed futures are now pricing in up to 5 25 basis cuts. And we're in March already. Now, I'm not saying I'm 100% right because they could change that. But what we're seeing is not only signs of a weakening economy, but fears are driving the economy. And when fear starts driving that economy, the Fed has got to help calm that as much as they can. And the bullets in the chamber that they have, or the arrows that they have, are Fed rate cuts. And I think that's what we're going to see. So they've got to be aware of this recession, the R word as well. I know the scared does. So now there's also a 40% chance of now a 25 basis cut coming up in the May meeting and a 100% chance going into the June meeting. It's gonna keep going. There's gonna be more and more of them. And just recently, the Atlanta Federal Reserve has updated their forecast for their most recent Q1 GDP estimates to be at a negative 3.7, which was supposed to come in at already revised at negative 2.8. It keeps going the wrong way. So you've got negative GDP, and we all know the statistical definition of a recession is 2 negative GDPs in a row, right? So we're getting close. So it brings me, full circle to that whole Fed point that these are reasons in combination with everything else I discussed from the unemployment rate, the job market, the list goes on and on. I mean, we've already tamed inflation, right? I'm not saying it's perfect, but it's tamed. It's under control. Now it becomes, okay, did we go too far? Because remember the soft landing versus hard landing? A recession would absolutely be a hard crash landing. It would not be good. And those are tough things to get out of once you're in them. And oftentimes we hear things like you never know you're in a recession until you're out of one, right? And here we are in Q2 starting to see some negative impacts of Q1. So let's talk about the 10-year Treasury, right? We did a whole episode on that. The 10-year Treasury, we talked about the yields. We talked about how you make a mortgage rate. You take the spread plus the Treasury, boom. But the one thing we talked about most recent couple episodes, I think it was 2 episodes ago, we talked about Scott Bessent and what he had to say. Could he save the mortgage market? Could he be the hero to the housing market? And he said things that we have never heard a Treasury Secretary say before that were so just, welcoming and refreshing, but you're starting to see it come full circle. He said, my job is to get the 10-year Treasury down. I can't control what the Federal Reserve does, and I don't want to control what the Federal Reserve does. I don't want to tell them what they need to do. I'd like to get the 10-year Treasury down below 4. He said most recently his target rate's 3.9, and that he would like to see the spread get down to 200, which he believes he can instill confidence in investors, and that will happen. So during the last couple of days, I'm going to pull up the charts here. It's kind of crazy to see what's happened to the 10-year Treasury. I mean, the 10-year Treasury right now is sitting at 4.00 as I make this episode. It's been moving all day. There's been a tremendous amount of volatility in it since the last 48 hours. But, I mean, we're seeing the thing move with great downward pressure, which is a big win, but he's got it to 4 already. He's not far from 3.9. Matter of fact, earlier in the day, it was at 3.8. So I think that he's doing his job and he's doing what he's supposed to do. And these tariffs are part of the journey. I really do believe that. So what does it mean for mortgage rates? Well, I'm going to have my producer play a clip. If you recall from our forecast we did at the beginning of the year, and I think I was one of 2 people that said this, and I had a couple people online mock us, but we give you specific reasons why. I'm going to play this clip and let you take a listen. I got us down to the 5.875 mid-year 2025. I do think we will get to that. I think if you listen to that mortgage spread podcast that we did, there's a reason as to why that can happen, because these spreads are getting better. It doesn't take the Federal Reserve lowering rates tremendously for that to happen, even on the heels of the Federal Reserve meeting that just happened yesterday, and a little bit of the kick in the teeth that the market got over the 2 rate cuts over 2025 forecast. I still believe that this forecast at 5.875 by second quarter, third quarter 2025 is available and possible. I think I'm one of only 2 people that are forecasting that, so we'll see how it lands. Okay, so you just heard that. So in that episode, we break down why we believe that's going to happen in the second quarter. Well, here we are, Q2. We are already there. We're already starting to see that number pop up on rate sheets. We're seeing that number pop up on the government rate sheet. It's very close on the conventional rate sheet. And why is that? Because that downward pressure on the 10-year Treasury, when you talk about how to make a mortgage interest rate, it's the spread plus the Treasury, we're right there. And the beautiful thing is we're sitting on the cusp of a Federal Reserve meeting, and it's not too far away. And when that meeting happens, I do believe the first cut of the season is going to start, and I do believe that's going to further move us into that 5.875 category on all products, if not lower on others. It's an exciting time to be in the mortgage business right now because it has not been exciting. It has not been fun leading up to this moment. And I will say this. We talk about this all the time on the show. What's good for the economy is not good for mortgage interest rates. What's bad for the economy usually is very good for interest rates, and it holds true again here right now. And so I can already hear it now. Someone's going to go, yeah, but you just talked about a recession. Well, remember this. The one thing that performs during a recession is housing. It's housing. Now go back to 2008 and you'll go, yeah, but it didn't perform then. That's the only recession in which it did not perform, and that was caused by housing. It was caused by bad loans, no incomes, no assets, 585, 100%, like stuff we would never do these days. That was all poor credit underwriting guidelines. I could easily argue for hours why that won't happen again. And when you look at where we are right now with the equity positions, because housing is going to benefit from this, it's going to continue to go up. New homes are going to continue to rise in price points. Now, I did want to say this. The one exciting news that we got out of this, and I do consider this to be exciting, from a new home front, it was said by the administration there'll be no tariffs put on lumber brought in from Canada. I thought that was really, really well done. Very smart. That will help and be a huge win for new homes and new builders and new homeowners. So, how can I say it? Let's let the home buying season begin, Charlie, and let the refinances begin because it's season. It's open season right now, and it's only going to get better from here. So I'm very excited. New home buyers, we've been talking about this. You may have been on the sidelines too long. If you're not in the game, get in the game. If you're waiting on the sidelines, get off the sidelines. Real estate agents, start pumping the database because it's going to be that musical chairs we're talking about. We're getting ready to be in full spring, into summer. It's coming. It's going to be exciting. Very pumped up about this. I'm sure you can all tell by my tonality on the phone. So you got it on the phone, on the mic. Oh, man. Well, hey, I tell you what, if you guys like what you're listening, please share this podcast with your friends, family, colleagues. It's always good to get fear out of the way and facts in the way because, facts over fear are what win here, and that's what we're bringing to the show here, not the media that you get out there every day on social media. So, guys, if you like what you're hearing, please share this podcast. 5-star review it. More importantly, go to our YouTube channel, check it out, subscribe, hit the like button, leave us a comment. We read all those on there. Till the next episode, guys, hope you have a wonderful week, and we'll see you back at What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.